How's it, guys? Today's video will be about the unicorn entry model, which I call the unicorn entry confirmation model because it consists of two ICT concepts used in combination to confirm entry. The two concepts used in the unicorn model are one, the breaker block, and two, the fair value gap, which can both be used singular as an entry confirmation. So before going into the video itself, into the unicorn model itself, let's briefly discuss what fair value gaps are and what breaker blocks are. To start off, we're going to start with fair value gap. So we're going to discuss the difference between the bearish fair value gap and the bullish fair value gap. What is a CP and what is a BS? Let's start with the bearish fair value gap. What is a bearish fair value gap? A bearish fair value gap is a three candlestick pattern whereby the low of the first candle does not overlap with the high of the third candle. What that means is, if you look at the chart here, you realize that we have candle number 1, candle number 2, and candle number 3. Candle number 1's low is here, and candle number 3's high is here. So the low of the first candle does not overlap with the high of the third candle. So the space that is left in between the high and the low is called a fair value gap. And in the form of a CB, a bearish fair value gap is a CB because a CB is a sell side imbalance and buy side inefficiency, meaning that sell side was offered but buy side was not offered, so buy side was inefficient. So the market has to come and rebalance this price. That's why you see the market came here and rebalance this price with an up move, with an up candle. Right now, let's go to a bullish fair value gap. A bullish fair value gap is just the opposite of a bearish fair value gap. What that means is, a bullish fair value gap is also a three candlestick pattern whereby the high, here we start with the high of the first candle, does not overlap with the low of the first candle. If you look at your chart, you realize that we have candle number 1, candle number 2, and candle number 3. So the high of the first candle is here, the high of the first candle is here, the low of the third candle is here. Here. So the high of this candle does not overlap with the low of this candle. So the spaces that is created in between this high and this low is what's known as a fair value gap. And because this is a bullish fair value gap, this is a BC, meaning buy side imbalance and sell side inefficiency, meaning buy side was offered but sell side was not offered. So at some future point, the market has to come back and rebalance this price with down candle. So if you realize the market, when it made this bullish fair value gap, it came here and made a high, then it came and tapped into the 50% of the fair value gap and closed the entire fair value gap with down candle. This candle opened and closed here, opened and went down here, and come and close here before going up. So in essence, that's what the fair value gap is. Now let's go and discuss what is a breaker block. Okay, the second leg of the unicorn model is the breaker block. What is a breaker block? Unlike a fair value gap, a breaker block is not a candlestick formation. It's a structural pattern whereby the market makes a high, price go up and make this high, put a swing high, then drops down and put this low, then sweep out this high here. This high is swept, making a higher high, making a higher high here, then displacing below this low and making a lower low. Making a lower low. So when you come here, you realize where is your breaker block? Your breaker block will be the last down candle here, the last down candle before this break of structure occurred. It can be the last down candle or a series of candles. So let's use a series of candles from this high to this low. So that's a bearish breaker block. A bullish breaker block is when it's the opposite of a bearish breaker block. So the market makes a high, then it makes a low, then it makes a higher low, a lower high, then it breaks below this low, making a lower low, then displacing above this high, and closing above this high. So now when this displacement occurred, our breaker block has been invalidated. Our breaker block will be the last up candle before this break of structure here. The last down candle here will be our bullish breaker block. Okay, so okay guys, now to the unicorn model itself. So the unicorn is a combination of the breaker block and the fair value gap. So I'm going to use the same example that I used for the breaker block. So you have the market making a low here, then it's making a high, then it's making a higher low, then it's making a high, breaking this structure to the upside, breaking this up structure to the downside, then again breaking this structure to the downside. Then you look for your breaker block, which will be what, the last down candle before this break of structure occurred. So what you again look for is, again, you look for a fair value gap. This is your breaker block. Then you again look for your fair value gap here, that overlaps with the breaker block. The fair value gap that overlaps with the breaker block. This is your fair value gap. It's a CB. And you take your short position here at the 50% of the breaker block, or at the 50% of the fair value gap. Use the fair value gap as, take your position there. Then you hide your stop loss just above this high, and you target a higher time frame PDRA, right? Similar thing with the buy position. The market makes a high, then it makes a low, then it makes a lower high, then it breaks structure to the downside here. Then again it displaces above this high. Then our breaker block will be the last up candle before this break of structure here. So what in the unicorn model, what you look for is, you look for also a BC that overlaps with the breaker block. BC that overlaps with the breaker block, and you take your buy position here at the 50%, depending on your risk management. At the 50%, you hide your stop loss below this low, and you target a higher time frame PDRA. What I also like to include is, I like to include the concept of discount and premium. So I like to buy in a discounted market and sell in a premium market. So when the market is not in a discount, I do not buy. Okay guys, now that you understand what the unicorn entry model is, let's go to the chart and look at a few. For our first example, we're on US 100, which is Nasdaq, right? So we're looking for an example of a bearish breaker block or a bearish entry using the unicorn model. So what you realize that here, you realize that we have this low, then the market made a high, then the market made a higher low, then the market closed above this high, making a higher high before displacing to the downside. So we have this high here that was broken here. So, and we had this displacement to the downside, right? So where is our breaker block? Our breaker block will be valid between this high and this low. So the last down candle, or a series of down candle before this break of structure, that will be our breaker block. So this is our last down candle here, our breaker block. And now we have to look for a fair value gap which overlaps with the breaker block. Where is our fair value gap? We have candle number 1, candle number 2, candle number 3. The low of this candle here, the low of this candle does not overlap with the high of the third candle. This is our first candle's low, and this is our third candle's high. So the space in between them is a fair value gap, which is a CB because it's a bearish fair value gap. CB. So you wait for them when you're trading the market. You wait for price to come into the breaker block and into the fair value gap. Then you take your short position at the 50% of the breaker block or the fair value gap, and you hide your stop loss above this high if you want to be safe, or you can hide it above the first candle's high or above the breaker blocks. And what do you target? You target, the first target is this low and this low and this low. So you can target the first low here, or you can target this liquidity, because these liquidities are going to be run. Okay guys, for a quick recap, the market makes a low, then it makes a high, then it makes a higher low, then it breaks the previous high, making a higher high. Then from the higher high, it displaces below this low. When it displaces, it validates our breaker block, which is the last down candle before this break of structure occurred here, right? So now you wait for the market to retrace into the breaker block, which overlaps with a fair value gap. Then you take your short position there. Okay. Okay, guys. For our second example, we're still on Nasdaq on US 100, but on the 15 minutes. I want to include as many time frames as possible so that you guys can see that this model does occur on every time frame. Okay. So we have the market making this high. So let me put this pathway here. You're looking for something like this. Don't forget displacement of then buy sell. Okay, we're looking for something like this. So we have the market making a high, then it's making a lower low, then it's making a lower high, then breaking this structure to the downside, making a lower low here. This is where it's making a lower low. Then from this lower low, it displaces above this high. It displaces above this high, and when it displaces above this high, it validates our breaker block. Where is our breaker block? Our breaker block is the last up candle before this break of structure occurred, or a series of up candle before this break of structure occurred. So where is our last down candle? Our last down candle is here, and our series of candles starts here. Do you do this? You'll get a 50%. If you want to refine it better, this is your breaker block. This is your breaker block. Then now you have to look for your overlaying fair value gap. Right? You have to look for your overlaying fair. We have two fair value gap. The first one is here, but this one, because it's not in premium, it's in premium. I'm sorry, it's in premium, not in a discounted market. So you want to buy in a discounted market. So check out your discount market. So you're gonna have to use this fair value gap here. This fair value gap here is the one that is in a discounted market, right? Then you take your buy position here at the 50% of this of the fair value gap. Then you target a high. You can target whatever high you want. You can start with this high and go further. And you hide your stop loss just below this low, And because here we are entering at the very close of the breaker block, there's no need for you to put your stop loss below the breaker blocks, because you're entering at the bottom part of the breaker block, right, guys? So the market makes a high, the market makes a lower low, the market makes a lower high. It's a lower high because it's lower than the first high. Then the market makes a lower low by breaking this low. Then when the market displaces above this high, we search for a fair value gap in between this low and this high. So there is a series of down up candle or a single up candle before this break of structure, before this displacement occurred. That's your breaker block, and you look for your fair value gap in the displacement above. So we have two fair value gap. This one is in a premium. We cannot buy in a premium. We're supposed to sell in a premium and buy in a discounted. So you look for a better one in a discounted market, and it comes here, and at the 50% of that fair value gap in a discounted market, that's where you buy. And for our last example, we're on the 1 minute, still on US 100, which is Nasdaq. So here you see the market make this high, then it made this low, then it made this lower high, then it made a lower low by breaking this structure to the downside. Then the market displaced above this high that it made. It displaced above this high that it made. When this displacement occurred, then the candle closes above this high. Then we know that we are looking for our fair value gap in between this low and this high, and it can be the last up candle, or a series of up candles before that break of structure occurred. So here's our series of down up candles. Then you have to look for your fair value gap. The only fair value gap that's here is here. So you can use this one as your entry if you want to risk buying in a premium market. You can use this as your entry and put up your buy position here at the 50% and hide your stop loss just below this breaker, and target the first high here and even higher highs, even higher than here. and take partials as you go along, guys. Okay, guys, in a nutshell, that's what the unicorn model is. The combination of a breaker block and a fair value gap. So you wait for the market to trade a structural pattern known as a breaker block. Then when it created a breaker block, you look for a overlying fair value gap. Then you come into the fair value gap and take your entry there, guys. Okay, if you have made it this far, please consider subscribing to my channel and commenting for future videos and critics and whatever that you have in mind, and I'll look into it. Peace out. Till next time.